So this is a question called Marchant. It's from the June 2014 exam. It involves partial disposals of subsidiaries. In one case we lose control and in the other case we keep control. What I've done is I've set out a pro forma, and this is in terms of technique, this is what I always recommend. I've set out a pro forma consolidated statement of profit or loss. I've seen that we've made a disposal of a subsidiary. So therefore what I've done is I've added in an extra line for the gain or loss on the sale of the subsidiary. I've seen that we've converted one of the companies from a subsidiary to an associate, so I've added in an additional line for share of profit of associate. Certainly in the exam, my advice to you is to write on every second or third line when setting out your pro formas, because you're never quite sure whether you need to include additional items. What was quite significant in this question was that we have other comprehensive income items as well. Strictly, you should separate them between items which are not going to be reclassified to profit or loss and items which will be reclassified to profit or loss, but frankly, in the exam, I don't think many people would do that. Then we split our profits between those allocated between the NCI and the group, and also total comprehensive income allocated between the NCI and the group. So that would very much be my first page. Also, as part of my preparation, I've set up the standard workings. So there's a group structure working, a net assets working, Goodwill, NCI, and profit or loss. I'm just going to make a slight adjustment to these because when they come up on screen, they just come up a little bit too far to the left. I'm just going to put in here so we've got our standard workings, group structure, net assets, Goodwill, NCI. Then working number 5 is going to be my profit or loss working. And all I do is I copy the headings from the question. Again, experience tells me that we need to leave plenty of space here because there's likely to be lots of adjustments to make. I've identified that we've got an associate, so I've set up a working for the associate, and there may be other workings required as well. But what I will be doing is going through in the 15 minutes before we can start writing, as far as this question is concerned, and identifying which additional workings we're going to need. And then it's a case of picking up the 2 marks or 3 marks for pensions and the 2 or 3 marks for revaluation, and think of it as not a 35-mark group question, but as a series of smaller questions, and I'm trying to pick up 3 marks here and 3 marks there and so on. The least important thing is actually working out the totals. So let's now start to work our way through the question in a bit more detail. And the first thing that we need to determine is the nature of the group structure. So we have Marchant, which is our parent company. And how do we kick off? Well, it's got an investment in Nathan, and that investment is originally 60%, but then it drops to 52%. And we make the disposal on Nathan on the last day of the year, which means that we don't have too many complications when it comes to calculating the NCI. We also have an investment in option, and that investment is originally 60%, and then it drops to 20%. So for 6 months of the year, we have an associate, and for 6 months of the year, we have a subsidiary. Therefore, when I go to my profit and loss working, notice I'm only going to include the activities of option for half of the year. Having established that, it's then a case of going through the question line by line. And the first thing that we see is the statements of profit or loss and other comprehensive income. So all I'm going to do is to go to working number 5 and start to slot in the numbers. So for Nathan, it's 400. Oops, so I need to just revise this again. Let me just pause. So we've got a column for the parent company and a column for each of our subsidiary companies. I've also set up a column for any adjustments. So initially, it's a case of going through the information, 400 plus 115. And for option, I'm only going to consolidate it for 6 months. So therefore, I'm only going to put in a figure of 35. Cost of sales, the same approach. 312, 65, and 18. I'm not going to put in subtotals for gross profit, operating profit, profit before tax, and so on, because this is just a working. And also remember, in the exam, there tends to be relatively few marks. In fact, there's no marks given for the subtotals. So we don't tend to worry about those too much. Got 21, 7, and 1. Admin expenses, 15, 9, and 6. Other expenses, 35, 19, and 4. Finance costs, 5, 6, and 2. Finance income, 6, 5, and 4. Income tax expense, 19, 9, and 2.5. And I'm going to work in this question to 1 decimal place. Sorry about that, ladies and gentlemen. The problem with being a celebrity. So we've now included all of the expenses. And also notice that we have some other comprehensive income in respect of the parent company, items that will not be reclassified to profit or loss. So I'm going to go to the face of the answer here, and I'm splitting my other comprehensive income between those which are not reclassified to P&L and those which can be reclassified to P&L. It's not something to get particularly excited about, but what we have here is a revaluation surplus of 10. So we've now dealt with that first article. Now let's take a look at the following information. We've got note 1. We've owned Marchant for 2 years. The purchase consideration was 80 million. So I'm going to go to my workings, and this is part of our goodwill calculation. Nathan, an option. So here we have the cost of the investment, and the cost of the investment is 80. And it says the fair value of the net assets was 110. So I go to my net assets working, and I'm going to have one for Nathan and one for option. And I'm going to do this at the acquisition and the disposal date, the acquisition and the disposal date, because those tend to be the key dates that we have to be able to deal with. And the fair value of those net assets is 110. It also says the fair value of the NCI was 45 million. So I'm going to go to the net NCI working and say at acquisition it's 45 million, like so. Marchant wants to use the full goodwill method, so we can put this into our goodwill calculation as well. And it says the share capital and retained earnings were 25 million and 85 and 65 million, so we've got ordinary share capital of 25. We've got a profit and loss account balance of 65, and we've got OCE of 6. And we know that the fair value is 110. Therefore, we can work out our fair value adjustment, and that's the balancing figure. So we've got a fair value adjustment of 14. And this relates to land, so therefore that's still going to be the position at the disposal date. It says goodwill has been impairment tested annually, and its value has been reduced by 30%. So what we can therefore do is we can calculate goodwill, because we've got all the information here, so we say less our net assets at acquisition. We've established that as being 110. So goodwill is 15. And the impairment of 20% means there's an impairment of 3 million. Should have gone through. However, at the 30th April X4, the impairment had reversed and goodwill was valued at 2 million above its original value. The upward change in value has been included in the draft financial statements prior to the preparation of the group accounts. Well, that's simply not allowed. If you impair goodwill, it cannot be reversed. So we cannot reverse the impairment. So what have they done? They've reversed this figure here of 3 million, and they've added an extra 2 million into the calculations. And that would, I'd imagine that's gone through to other income, because that's what you'd normally do with something of that nature. So what I'm going to do, I'm going to go to other income here and say that we've got our goodwill reversal . So it's the impairment of 3 million and the additional amount of 2 million, and I'm going to say that's not allowed, so I'm going to take 5 million out of other income, because that's an error which has been made by the company. Note 2, Marchant disposed of 8% of Nathan for a cash consideration of 18 million. So let's now deal with that disposal. So I'm going to open up a new working number 7. So we have the Nathan disposal. How much have we sold it for? We've gone debit cash 18 million. And we're going to credit the NCI with their increase in the value. But we need to be a little bit careful here. Let's just read the question. And this bit is really messy, really unpleasant. It says the carrying value of the net assets in Nathan was 120 million before any adjustments. So therefore, if we add on our consolidation adjustment of 14 million, the net assets are worth 134 million. So what I'm going to say here is that the NCI are going to get their share of that 134 million, but because we're using the fair value method, we must also take into consideration their share of goodwill. And goodwill is 12 million. So the value of Nathan at the date of the sale is the value of the net assets, 134 million, plus the 12 million of goodwill. And how much are we giving to the NCI? We're giving them 8%. So 134 plus 12 gives me a figure of 146 times 8%. And that gives me a figure of 11.7. What do we do with the remaining part? Well, that goes directly to equity, 6.3. So that's taken directly to equity, so it does not appear in other comprehensive income as such. So that's actually part B, or part A2 of the question. It says Marchant accounts for investments in subsidiaries using IFRS 9 as made an election to show gains and losses in other comprehensive income. The carrying value of the investment in Nathan was 90 million at the start of the year and 95 million at the end of the year before the disposal. So what we need to do is that the gain in respect of Nathan in OCI has to be reversed in the group accounts. Therefore, we're going to debit OCI 5 million and credit the investment 5 million. So yet nobody would get something of that nature. So that revaluation surplus of 10 million, we'd actually reduce that by 5. And that's come from working number 7. Really nasty adjustment. These are the type of things that I don't expect any student to deliver in the exam. Note 3. Marchant acquired 60% of option on the 30th of April X2. The purchase consideration was 70 million. So let's focus on the bits that we are familiar with. Let's make sure we pick up the easy marks in the exam, or no easy marks, but the easier marks. So we've got a cost of 70 million. The net assets were fair valued at 86. So I'll slot in that figure there. of 86. And the NCI had a fair value of 28 at that date. So we say the NCI at acquisition has got a figure of 28. We're using the fair value method, so I'm going to add on that figure of 28 to our goodwill calculation. And it says options net assets were valued at 86. So we've got that figure of 86 to subtract. And therefore we can work out goodwill as being 12. So just slot figures into your standard workings, even though the standard workings you might not be using them in full, because this way you don't have to reinvent new workings every single time. On the 1st of November X3, Marchant disposed of a 40% option in interest for consideration of 50 million. So what I'm going to do now is open up a new working number 8, sale of option. So we've got the sale proceeds. So we've sold the shares for 50 million. We're told in the question that the NCI at disposal is 34. We're also told that the remaining investment was valued at 40. And then we take away the net assets at disposal. And again, the examiner has told us this. And we also take away goodwill at disposal, and we've calculated goodwill in working number 3, and we calculated goodwill to be 12. So 50 plus 34 plus 40 less 90 less 12 gives me a group gain on disposal of 22. So the examiner's actually given us nearly all of those figures. So what we can now do is we can take that group gain and we can show that on the face. Gain on disposal of subsidiary from working number 9, got a figure of 22. That deals with Marchant for the first 6 months of the year. We also need to be able to deal with the disposal for the last 6 months of the year when it's an associate. So we can say here, we can work out the share of profit. How much profit has option made? It's made 15 million for the year, and for the last 6 months of the year, we have 20%. That gives us a figure of 1.5, and that figure of 1.5 that comes from working number 6. Again, that's an F7 issue. It's only worth 1 or 2 marks, but it's a relatively straightforward calculation. And what I want us to be able to do in the exam is to say, some of the issues are horrible and complicated. Actually, I'm going to ignore them. Other bits I know how to deal with, and I'm going to pick up those 2 marks here and those 3 marks there and so on. No impairment adjustment is required. No entries have been made in the financial statement. So we've dealt with note 3. Note 4, we've got intragroup sales of 12 million. So what I'm going to do here is I'm going to reduce revenue by 12 million and cost of sales by 12 million. It says Marchant made a loss on the transaction of 2 million. So if it made a loss on the transaction, we should always value inventories at the lower of cost and NRV, so no further adjustment is required because there's no intragroup profit. So you might want to stick that down as a note, and I'll just put that down as a intragroup trading, no adjustment for the loss because inventory is measured at the lower of cost and NRV. And because we've sold them at a loss, we've reduced the value to NRV. So that deals with note 4. Note 5, we've got some pensions. And all I'm going to do is set up a little table with assets and liabilities. And this is nothing to do with groups, is it? It's if we know our rules on pensions. So here we've got an opening balance in respect of pensions. $48 and $50. We've got the service cost is 4. We've got our discount rate, so we've got the interest 4.8 and 5. We've got a remeasurement loss of 2, and that is taken to OCI. We've got a past service cost of 3, which is added to the liability, and then we've got interest on the past service cost, because notice the past service cost is at the start of the year. So 3 at 10% is 0.3. So what we need to do is to add all of these together, and into the statement of profit and loss we've got our service cost plus our interest cost plus our past service cost plus the interest on the past service cost less the interest on the assets, and that gives us an expense of 7.5. So there's 3 or 4 marks going for that. If you know how to deal with pensions, those are relatively easy marks to pick up. So this question is really to do with technique. So I'm going to go to other expenses, pension, 7.5 from working number 9. Let's now take a look at the next note. So it says the pension costs have not been accounted for in total comprehensive income. So we've put the pension cost there of 7.5, and what I'm also going to do is I'm going to go to other comprehensive income. We've got our revaluation surplus, and we've got our pension remeasurement cost, and we've established that that was 2 million. Item 6. Working number 11, we've got PP. Again, nothing to do with groups, nothing to do with P2. It's a case of working your way through things from the dates. So on the 1st of May, X2 cost 12 million. We then have depreciation to X3 of 1.2, so that takes us down to a figure of 10.8. We revalue to 13, so therefore we've got a revaluation surplus of 2.2. We've got depreciation to X4, so that's going to be 13. And now we've got 9 years remaining of the asset, so our depreciation is 1.4, which takes our asset value down to 11.6. We then revalue the asset again, and we have an impairment, and the impairment takes the asset down to a value of 7. So our impairment loss is 4.6. 2.2 is deducted off the revaluation surplus, and 2.4, the excess, goes to the statement of profit or loss. That is all F7 knowledge. So you actually see in this question that we've got intragroup sales is F7, there's a mark there. We've got this adjustment here, it's another 2 or 3 marks. So you cannot afford to forget your basic understandings. So I'm now going to take that figure of 2.4, loss impairment, which working is that? Working number 11, good grief. And I'm also going to go to other comprehensive income not reclassified to profit or loss. Revaluation loss 2.2 from working number 11. Item 7 or 8 or whatever it is, is share options. Again, nothing to do with groups. So long as we can remember our rules in respect of options, what we can say here, we've awarded 8,000 options to 7 directors. There's a 3-year vesting period. We started in X2, and we can say at the end of the first year, so at the 30th of April X3, what do we have here? 8,000 options. They're worth $100 each. We are 1 year into a 3-year vesting period, and we think that 4 of the directors are going to stay in the scheme. So therefore our total cost at the end of year 1 is 1.1 million. At the 30th of April X4, 8,000 options, fair value at the grant date is 100. We are now 2 years into a 3-year scheme, but we now believe that only 1 director is going to leave. So therefore there's 6 people in the scheme, and that gives us a total cost of 3.2 million. So the cost to the statement of profit and loss is the movement in the year. It's 2.1 million. I'm going to take that figure of 2.1 million Share options, working number 12, 2.1 million, and add that up like so. Okay. Item 8, a loss on an effective cash flow hedge of 3 million has been included in finance costs. Well, cash flow hedge losses should be taken to OCI. So all I'm going to do here is to go to my finance costs working and take out 3 million. So that's going to be cash flow hedge. I'm going to reduce that by 3 million, and I'm going to transfer that to the face of my answer. Now, you can reclassify that to profit and loss when the transaction materializes, but again, this is not something I expect any student to get. Cash flow hedge loss 3 million. Those are all losses, those shall be negatives. Okay. Is there anything else here? Ignore the taxation effects of the above. That's jolly good. It's very kind of the examiner. Let's not turn it into a tax question. Requirements would prepare a statement of profit or loss and OCI, and how the sale of the 8% interest in Nathan. Well, we've dealt with that in working number 7. So what we can now do is start to tidy things up. So I've got a revenue figure 538, cost of sales 383, as far as other income is concerned, I've added up my totals here, but included in other income is the gain on the sale of Nathan as well. So we need to work out what that was, because we were told that it was taken to income. So how much was that gain on the disposal of Nathan? That was a figure of 6.3. Let me just check that number, that particular bit. So what we will do here is that strictly what we should have done is calculated the gain on the sale to the parent. Again, nobody would have done that in the exam, so I'm going to ignore that. So I'm going to combine all of these figures. 21 plus 7 plus 1 minus 5. So I've got here a figure of 24. Admin expenses, we can add those together. 30. Our other expenses, an awful lot of adjustments. 35 plus 19 plus 4 plus 7.5 plus 2.4 plus 2.1. And that works out to 70. Finance costs after the adjustment come to 10. Finance income is 15. Tax is 30.5. And then you would transfer all of those figures to the face of your answer, and you would work out the NCI on those totals just by multiplying through by the percentages. But as you can see, there's an awful lot going on in this question, and there's an awful lot of tidying up that needs to be doing as well. So we transfer all these figures, you could work out your subtotals and so on. That's the least important thing, part of the question. But let's just take a look at those numbers. So what have we got? Revenue 538, cost of sales 383. These are all coming from working number 5. Gross profit 155. The other income, I think, was 12. Let's just check, can't remember. Other income was 24. We ended up with administrative expenses of 30, other expenses of 70. So 155 plus 24 plus 22 less 100. Operating profit 101. Finance costs 10. Finance income 15. $107.5 less tax of 30.5. So I've got a profit for the year of 77. We've then got our other comprehensive income, 5 less 2 less 2.2. And we've got the 3 million of cash flow hedges. So overall, 3 minus 0.8. We've got total other comprehensive income comes out as minus 2.2. So our total comprehensive income is the 77 minus the 2.2. Gives us a figure of 74.8. The most important thing is that we work out our non-controlling interests. And for Nathan, we've not made any adjustments to Nathan's profits, so we take a look at Nathan's accounts. Nathan has got a profit of 19 for the year. And the NCI I've got 40%. And for option's got 15. We've got an NCI for 6 months of the year, and for that 6 months of the year, they're entitled to a profit of 40%. That works out as 10.6. What's happened there? Something's gone a bit nuts. Out of our profit of 77, so to the shareholders of the parent, is simply the balance. So 77 minus 10.6 is 66.4. And when we're doing it on a non-controlling, when doing a total comprehensive income basis, we say that our total is 74.8. The non-controlling interests still take their 10.6. And the shareholders of the parent, always just give them the balance. Now this answer isn't perfect because I've not dealt with the gain on disposal to the parent company in this, which would have been thrown in a totally comprehensive answer. Not a single student on the planet would remember to do something of that nature.